Okay, hi everyone. It's great to be here with you. Great to be back at Cybertech, and great to be in a physical event. It's been 18 months for me. Our panel today is called How to Build a Unicorn, if we all knew. To kick it off, let's have each of the distinguished panelists share a little bit about themselves. John, how about I start with you?
Absolutely. John Brennan, I'm a partner at Wild Ventures. We invest exclusively in seed stage cybersecurity companies in Israel.
Yeah, Matt Carbonara, Managing Director at Citi Ventures. I lead our enterprise practice, and one of the critical areas of that practice is cybersecurity. So excited to be here and looking forward to the panel. Thanks for having me.
Hey, Tal, thanks for having us. I'm Yaron Elad. I'm the CEO of Elron. Elron actually is the first ever VC from Israel, operating for 60 years, investing in early stage ventures in different verticals. And the last decade or so, we're focusing on cybersecurity and enterprise software, working closely with our strategic partners, creating some kind of a multi-corporate incubation, working with both Rafael, Siemens, a few of the insurance companies in Israel, banks, and others to help them reach product market fit. So that's us.
Yoav, over to you.
Hi, everyone. Good to be back at Cybertech, and thanks, Amir, for inviting us again. So just a bit about JVP, Jerusalem Venture Partners. We were founded in 1993 by Ariel Margalit. We now manage about $2 billion in assets under management. We've invested in about 150 companies, of which about 30% are cybersecurity. Perhaps best known for CyberArk. Udi was just sitting here earlier, so we were the largest investors, holding 47% of the company just prior to the IPO. We have about 20 active cybersecurity companies of all stages. That's where I spend most of my time these days.
All right, thank you, everyone. So there are more unicorns out there than ever before. So many that some question whether the title of 1 billion actually warrants the status of unicorn. So while building unicorn may be more feasible than ever before, it will still take blood, sweat, and tears to actually get there. So starting with this trend, why do you think that there's such a spike in the number of unicorns in general, and specifically within the cybersecurity industry? How about we start with you?
Sure. So look, I think that it was discussed earlier, the availability of capital, the low interest rate certainly drives public company valuations up, which in turn creates an influx of money also into the later stage and then earlier stage venture capital-backed companies. But I think that when you look at who does it really serve, right, those valuations that some would say are inflated, so you need to ask yourself, who does it serve? And because the equity is, there's no market for most of the equity in these companies, and they can't really even spend at the level of the money that they raise. So it basically serves great teams. I mean, Asaf was here on the stage just now, certainly a very accomplished individual. So great teams that have good understanding of the market, for sure that they know that they will not be able to build organically all the technology that's needed to solve the problem. And what these companies have is actually very cheap, I would say, equity that they can buy, that they can use in order to try and aggregate value around that great team that was founding that startup. So it serves the shareholders of that company to really become market leaders, to really become dominant, to gobble up a few smaller startups, and hopefully create a market leader by doing that.
Matt, what has been your impression in the US?
Yeah, I mean, I agree with a lot of those points. I think the other elements I would call out is just the growth rate of some of the companies in this market. I mean, even look at now, SentinelOne, 100% a year. You have CrowdStrike, 60, 70%. And those are scaled companies growing rapidly. Even Palo Alto, I think, is still growing pretty, 25% a year at a very large scale. So I think when investors see the potential size of the outcomes and the growth rates and scale of those companies, I think that drives a lot of interest in that. And so those end markets, the size of those end markets, I think is one. I think the other is the stakes have gone up, right? The potential negative consequences of what could happen is driving more demand on the consumer side as well. And so I think that has risen, helps drive the growth rate and the market size for these companies. Those are the two things that I think have really, I've really seen. And then I think maybe to some extent this working in a hybrid remote environment has added the complexity, and that again has just driven more demand for these types of products. So an acceleration of the market is what I would say, based on the environment that we're in. So.
Sure, it really does feel, and statistics are fully supporting this, that becoming a unicorn has become easier than ever before. We're seeing the time to unicorn, we're seeing that the revenue threshold has decreased significantly. What are the main drivers, do you think, Yaron?
Yeah, I think following Matt's and Yoav input, first of all, in cybersecurity, you can see it today. People understand that cybersecurity is more like healthcare. And when you have disease IT, you must solve it. There's no other way but defend yourself with cybersecurity products. I think that the element of having second and third timers as entrepreneurs are driving the potential of those early stage startups. I think that having a very unique environment, certainly in Israel, to incubate startups in early stage, and well-known phenomena of building the product market fit and the knowledge that we have in order to do so from early stage and build the product the right way is really creating a shortcut, as Matt mentioned. Once you have it, then multiply it with the potential is easy. I think my colleagues didn't mention that the SoftBank phenomena around us with Insights and Tiger of the world obviously is driving everything up and allowing those kind of current unicorns, like Dean spoke earlier, just to have this product market fit, and then the sky's the limit.
Thank you. I think we, around the table here, we all have an individual perspective on being part of a unicorn story in one way or another, and I'm sure the audience will appreciate that. John, how about I start with you? What has been your experience?
Yeah, so over the past several years, we've been very lucky to work with amazing founders in two of those teams, both at Exonius, and Dean was up here earlier, and at Orca Security, which is still in our portfolio. Both have been able to achieve that level of valuation, and it's kind of funny, we're here to talk about how to build a unicorn. I actually don't think as investors we do build the unicorns. We're supporting amazing founders that can. And for me and for us, what we really stress is sticking to the fundamentals. So we can't control the markets. So I can't say, and $1 billion is a relatively, I would say, arbitrary valuation. 500 million, 5 billion, whatever it is. But from our perspective, and we have the benefit of this being so early, is if we can really focus on incredibly capable people with large ambition, tackling large markets, whatever that absolute number is going to be, it is what it is. But if we bet on the right teams in the right spaces, we're hopefully going to end up with winners. Now, what the scale of those winners are, again, I tend to think is out of our control. But what we can control is investing in the right people. And again, we don't build the unicorns, the founders do. And so from my perspective, seed stage, very early, there's not a whole lot to evaluate. It's all about people, and that's really where we focus a great deal of our time.
It's a great answer. Matt, we'll go round.
Yeah, I think the thing that is, the other thing I would add is really enabling these companies to become so large is two things. One, the largest ones are building platform companies that they start in one area, but they can address multiple areas over time. And I think that certainly gives investors excitement about the size of the opportunity that they can ultimately address, as they can pull in other pieces of functionality. The other thing that I think is changing in this market is the way that these companies are going to market is different, and that enables them to scale faster. And you can grow these companies faster than you used to in the past, whether it's going to market through some of the cloud providers and attaching to their services. And that's something you can spin up instantly versus, well, I had to order a physical firewall and deploy it and turn it on, right? So I think the go-to-market and that approach, I think, is really making a difference for some of these companies in terms of how quickly they can grow.
Fascinating. You're on?
Yeah, I'm totally agree. Once once product market fit is achieved and you have this tremendous amount of dry powder around us that can drive, and the knowledge that we have in the cyber market, how to grow a business and to implement the right KPIs for growth. I think that's a major driver for everyone. So basically the experience that we have around us is a major driver to that. It reminds me in a way, although I was a student back then 20 years ago when the dot-com valuations were there, I think there's two main differences which makes this atmosphere hopefully more sustainable. First is that the world is more ready to absorb new technologies, certainly after COVID. And everyone understands that technology and digital is there. And then I'll tell you how I know it. That my 75-year-old mother just got its first tablet last week. So if she's there, everyone's there.
Sure, Yoav?
Yeah, look, for us, I mean, we're all venture capitalists here on the panel, and venture capitalists, despite the fact that we maybe perceive ourselves as subject matter experts in cybersecurity or any other domain, at the end of the day, we need to generate financial returns for our investors. So, and the financial returns equation, especially if the end goal is the public market, is pretty clear. What you need to achieve, what's the return on equity, what's the return on investment ranges that are expected in the market. So yes, today we're in a very bullish market where valuations in public securities is going up, but the brackets are pretty well known. So for us, it's really a question of going back to fundamentals, growth rates, efficiency models, return on investment, breaking it down to the sales metrics, CAC, lifetime value, all that great stuff that we all know, and really keeping the discipline towards those results. Yes, there are companies that perhaps will reach multi-billion-dollar valuations without that, okay? But if you, as an investor, you wish to build or influence a company in any way that will improve the likelihood of getting there, it goes back to fundamentals, nothing else.
If we're thinking about sustainability and about continuity, about this trend in general, do you feel that once you've been part of that experience, either as an investor or an entrepreneur, you increase the chances of leading to the next one? Does it give you an edge looking at the next company? Do you think it feels different to that entrepreneur that's been there moving forward?
Yeah, look, investors are a weird crowd. There's a herd mentality for a lot of the things that we do. And therefore, certainly success yields success for sure. But I think that there was a study that showed that actually the likelihood of success with repeat entrepreneurs is not higher than with first-time entrepreneurs. So yes, it is easier to attract capital, but from a statistical perspective, it's actually easier to lose money with repeat entrepreneurs.
I totally agree with Yoav. I think the typical answer to your question will be yes, but I will differentiate to three categories. For us, the early stage investors, I think it doesn't matter. It matters if you know how to identify the right team and the right talent. You must take the journey of failures, of successes, of early exits, of later stage exits, of IPOs. I think that's what makes you an investor that has the ability to identify a unicorn. And I agree, I'm not sure that you can do it in early stage. For the later stage investor, it's a different ball game. You must bet that those KPIs that the growth engines will maintain, and this is more of a complicated one. So I would say for those, certainly yes. And last but not least, the entrepreneurs, I think it's a definite yes. The easier, first and foremost, it's easier to attract talent if you already built one. And that's the most important criteria. And needless to say, as you have said, easier to attract capital and other stuff.
As we're about to run out of time, and in the essence of time, just going around the table very quickly, one major tip on how to build that unicorn. I know it's like asking how to create that great viral video on YouTube, but nonetheless, one thing from each of you, how would you start in looking at the next big unicorn story? John.
So I think, as I said before, it's just all about the people. And so the way I look at this market, and generally we're not the ones coming up, independently in a vacuum with an amazing thesis. It's maybe an area that we didn't even think was that exciting, but the right people come to us with the right idea. And just to very briefly go back to the last question, I want to mention, yes, I do think experience building unicorns and all of that is great, but I also think the more negative experiences or middling experiences in a lot of ways can help people get to the next level. And that's a lot of what we look for at the early stages.
Great. Matt, over to you.
Yeah, I think, look, my advice would be, I agree with everything that's been said, is, focus on building something that's ultimately a platform and thinking about new go-to-markets. Because I think that's where this pattern matching sometimes goes wrong is, pattern matching works until it doesn't, and then you miss something and your anti-portfolio is a lot bigger than your portfolio. So, I think thinking about being flexible about how you think about those things can be really helpful. But I think, new go-to-market approaches, because ultimately these companies that are so highly valued are valued not just because of the products that these great teams build, but also now they have a new channel to customers and they can start to sell more stuff through those customers. And that's what enables them to be really big outcomes.
Thank you, Yaron.
I do my best to just
your big tip.
One tip. Again, I think since it's all about product, so I would say take your time when you're seeking the right product and you're seeking the way to build it. Do it yourself in the first dozens of customers. Do it yourself as entrepreneur. Be the front in front of the client. Understand his needs. And feel the market. And another minor tip, try to avoid not being the first to market.
That's a good one. Yoav?
I think these are all great tips. One thing that is a challenge, but I would provide that as a tip. Keep your head in the sky in terms of the vision and the growth and the belief and so forth, and your feet on the ground. So make sure that you know how to manage your business day to day, and that you don't confuse yourself with one valuation or another, or an investor chasing you, or a customer win. Make sure that you continuously building a true category leader.
I think you have won this competition.
I hope this is helpful for you guys. We definitely will take some credit if you guys have the next big idea. To wrap up, so we're all experiencing a very unique time, unprecedented growth in the tech sector. This is yielding more unicorns than ever before. And while it's still extremely challenging, it's an incredible opportunity for both investors and entrepreneurs. Thank you so much for each of the panelists. Thank you for being a great audience. Have a great one.